well, that's good enough for me. I'm just going to own half stocks and half bonds.
Can I ask a quick question?
Mm-hmm.
At what age would a person be at a plan where you would have half stocks and half bonds?
You could be at that place at any age if you had enough money. In other words, based on your savings goal and your investment risk tolerance, you could be there anytime. And let me kind of digress and make another point is, it doesn't necessarily mean when you start out that you should take the most risk. When you start out investing, and say you're in your 20s, there's only three things. There's amount, time, and return, okay? And when you're investing, that's really all there is, amount, time, and return. So you're young, the theory is you have a lot of time, so you buy the most risky asset class, and you just let it go, right? Well, what happens if a kid comes up and buys $100 worth of stock and tomorrow it's worth $50? You think the kid, without any financial education, is really excited about their investment and they're going to keep buying? Probably not. They might very well get frustrated and get out. So most of the important thing when you're starting out is to develop a habit of savings. So you want to be successful, right? So you actually could, there's a strong indication that the most important thing to do when you first start out is to be very conservative. The other thing that's clear is for 6 or 7 years, it doesn't matter what kind of return you make when you first start investing. So return is kind of irrelevant. Now, in your later years, return is very relevant. In other words, if you haven't figured out how to make money in the markets, you're not going to survive. You're not going to make your money last. So it really depends on your goals and your cash flow needs and what it is that you want to do. But I usually encourage kids starting out, unless they've been in finance class and can understand the down markets, to start off pretty conservative and then get a little more risky as they go along. Okay? So it doesn't necessarily follow. But if you can afford to be at 50-50 in your 30s, why take more investment risk than you need to? It's the bottom line. You know, we don't need to if we don't need to take it in our portfolio, we shouldn't, to meet our particular goals. So it's that marriage of goals and investing. So if we start out with a plan of 50-50, and let's look and at the end of the first year, we're at 60-40, bonds being 60 and stocks being 40, what happened that year? If I started the year at 50-50, stocks and bonds, and now I only have 40% stocks, what do you think happened?
You have 40% in stocks, did you say?
Mm-hmm.
Yeah, stocks did poorly.
Stocks did poorly that year. Okay, so what are you going to do if you have an asset allocation plan of 50-50? You're going to readjust. You're going to buy some stocks and sell some bonds. So you're going to buy the things that have been making money for you, and you're going to buy the things that have been losing money for you, and you're going to buy the things that have been making money for you, correct? Now, how many of us really want to do that? I don't know how many times I've sat with people and said, oh, don't sell this, Mackey. It made 30% last year. Well, where was the thing that made 30% last year? Remember that colored chart that we had? All the different colors on it? Things with risk and return, and we looked at the asset classes. What happens to the things at the top? And they end up at the bottom. So if we have an asset allocation plan, what it does is it gives us a discipline to sell at the top and buy at the bottom, which is how we make money, right? So having the asset allocation plan puts the discipline into it. So if we keep moving, we've rebalanced at the end of the year. We're really good. We don't look at our statements for a whole year. We open them up at the end of the next year, and we have 35% bonds and 65% stocks. Okay, so now what are we going to do? Readjust. We'll sell our stocks, which have probably just had a killer of a year if they've adjusted that much. And but what's the tendency of most people? My stocks are doing so well. You want to keep them, right? But that's when you need to sell them. Sell at the height of optimism, buy at the point of pessimism. The planning, having a plan, having a fixed asset allocation gives you that discipline. And we're going to buy bonds and sell stocks. Go back to 50-50. So that's just an example. What we do actually looks a little more like this. In other words, there's a whole lot more things to buy besides just stocks and bonds. We actually have 15 asset classes in our portfolio. So we have timber and commodities and U.S. stocks and non-U.S. stocks and small cap stocks. And we have an asset allocation to each asset class. And we buy and sell within that asset class. Okay? Because those markets all work differently. Bye. Thank you. So I said, does anybody have any questions about asset allocation before I go on? Does it make sense? Kind of?
something you do on a yearly basis?
We actually rebalance quarterly, or if the markets are moving. You can actually, if the markets are moving quickly, we would balance in that period to take advantage of the volatility. So how's the future going to be different? We said it's not different, but some things are different. This is a slide that shows the investable capital in the world. Do y'all see? Can you see where it says U.S. bonds? Do you see what that number is? Mm-hmm. It's maybe hard to read from the back. 25%. Of the investable capital in the world, 25% is in U.S. bonds. What's in U.S. stocks?
When you say U.S. bonds, you're talking about U.S. government bonds, not
U.S. bonds of any kind.
of any kind.
Of any kind. How much is U.S. stocks? Do you see that number? 16.9%. Do y'all see that? So of the world capital, 16.9% is in U.S. stocks. What about U.S. real estate? You'll see that number? 6.2%. Okay. So if you add all that up, what's the U.S. portion of the market? Of the world market?
47.
About 47. So is that more or less than you thought? Do you think less? Yeah, so over half of the world's investable capital markets are outside the U.S. Very different than a few years ago. And that trend will continue. So one of the things about the future is money's going to be made more overseas than it's going to be made in the U.S. Why do you think all the large U.S. companies are building plants and opening stores in China, Brazil, India, etc.? They know where the shifts are occurring. They want to be over there. What else is different? So U.S. growth is going to be different. Non-correlation, because we have more of a world interdependent economy, the foreign markets and U.S. markets tend to work more alike than they do separate. There was a time that international markets and U.S. markets were very uncorrelated, but now they're more correlated than ever. So just owning foreign stocks doesn't necessarily give you enough non-correlation in your portfolio. Management matters. We've been willing to invest just based on how much money does something make. So I think that's part of the problem. When I look at it's very easy to get caught up, and it's really easy to me to get very angry at the Madoffs of the world who walk away with billions of dollars of other people's money, or the Merrill Lynch CEO who spent $1.2 million on his office. But those are examples of, just give me the bottom line. What's in it for me in terms of profit? And if I'm investing from a standpoint of what's in it for me just for profit, well, then I'm doing the same thing. What about values and ethics? Where do values and ethics come into the investment equation? And maybe what's happening right now is we're having a wake-up call to say values and ethics are just as important as the bottom line. And maybe that's part of what we're being called to look at. And the good thing is studies show that companies that are well managed, that take care of their employees, that have independent boards of directors, and normal, or whatever is normal in this day, CEO compensation, actually perform better over time than companies that don't have those policies. So we're not used to say that if we socially screen our portfolios, we make less money, but the reverse is true. If we begin to look at how companies fundamentally operate, and if they do, are they doing good in the world as well as making money, we can actually improve our portfolio performance. So management, more than ever, I think matters. Global warming. I had somebody in the morning class that said, that's no such thing. But I believe that global warming is a fact of life, and it's going to change our economy. It's going to change our environment. And it's going to change our financial markets as well. If we start trading carbon, that'll be a huge financial market. I mean, trading carbon, we're going to buy and sell carbon credits. It wasn't even something you can buy and sell a few years ago. It's become a major market. And alternative asset classes. Because of the correlation between the U.S. and international markets, we're going to need to look to other asset classes to give us that non-correlation. So what are those? Things like real estate has always been somewhat non-correlated. Frontier stocks and bonds. We talk about BRIC, which is Brazil, Russia, India, and China. But even there are countries that are even behind that in terms of their growth. So the third Eastern Bloc countries are now coming along. People are moving plants into Romania, those kind of countries. So we need to look at what are the frontier stocks. Currency, there are actually currency funds that you can buy. Commodities have a very different